Good morning, everyone. Welcome to this update for the 20th of August. And I've titled this Relax, This Is Not a Top. And the reason I've done that is because in the last week, I've had a few more questions than normal about the behavior of the market. And there's no question that we've had back-to-back weeks where there was a single down day that was sharp. And we haven't seen that for quite a long period of time. So I think there is some evidence there that the market is undergoing a bit of a change of character. But of course, the big question is this just into a sideways reaccumulation zone, or are we going to get something of a deeper correction? So that is one of the things that I want to look at in this edition. So I'll have a look at the precursors of market tops, and you've got to have these things in place to get a market top. And I think you'll see pretty clearly that that's not the case. Just want to have a look at the behaviour of global stocks and indices. We'll look at the US, Europe, China, and Japan. And of course, we'll take a look at commodities as well. As I've been mentioning over the last couple of weeks, I'm launching a new service, and that will occur this week. And so look out for those details. Just to outline that there's going to be an emphasis in this on the stocks of interest to you. This is not. I'll be putting forward some stocks that I uncover, but it'll largely be about stocks of interest to you and the group, and that of course brings into play the enormous benefit that you can get from all of the surveillance and thinking power of everyone else in the group as well. Last week I went through an example charting analysis, but of course there'll be some in-depth fundamental analysis of as well of what you may already own or what you're thinking of buying, and it'll cover US and Australian stocks and ETFs. So look for that during the week. So let's take a look at a big picture global perspective. What signals are there that a top may be forming? And these are the things that almost always have to occur because that's just the way that markets work. You need to get some sort of period of euphoric buying that we saw that led into the top in 2000 and the top in late 2007, where a lot of the money is in the market, and you also see a rapid price escalation. Now, you know as well as I do that we've seen neither of those two things in this particular market. It's just been a steady grind higher, which is the hallmark of a really good, strong bull market. It's neither been, all the economic data has been neither too weak or too strong. It's just been about right. There are no signs of an economic recession. In fact, we're getting, for the first time, we're getting synchronized global growth throughout the world. So almost all major tops in the market are preceded by, perhaps 6 months to a year with an economic recession, or certainly the beginning signs of it. You also see declining market breadth, and I showed you a chart last week that demonstrates that that is definitely not the case, and I can assure you that nothing much has changed in the last week. You see rising volatility and larger volumes on the down days. We saw a little bit of that in the NASDAQ last week, but when you look at the weekly chart, it's anything but definitive. So we're certainly not seeing that. We're not seeing rising volatility, and I'll show you the VIX index as well. Yeah, we got a little spike, but it only lasted 24 hours, and that was it. And you also see a breaking of the initial spike lows. Now, for a start, we haven't had any spike lows to break, so that's really the end of that one as well. And I've covered that example. I do it about 3 or 4 times a year, where I look at those 2000 and 2008 market tops and just show you how much time, how much advance warning you get. You get months and months of advance warning of a top in the market. It's not a difficult thing to do. So with that, let me put that to bed, that this is not a major market top, and we'll have a look at the specific stocks in a minute. US reporting season, we've just seen back-to-back quarters where earnings growth has been above 10%. So again, that just completely blows out of the water the suggestion that that there's any sort of economic downturn occurring or looming. The US dollar is still holding above that key support, hasn't really bounced yet, but then again, it hasn't broken it either. The S&P was down by 16 on the week. The volumes were elevated on the NASDAQ when you look at that on a daily chart, but really not anywhere else. Most of the volumes are still pretty modest. So this is not panic selling. This is not gross removal of money from the market. This is just some profit taking in certain sectors that have done incredibly well, particularly in technology. So I think we're likely to get a period of short-term weakness. Now, it could be just another 2, 3, 4% down in the market and a zone of sideways ranging for a while, but I just don't see anything other than that. So the highest odds to me favour a reaccumulation range before we get a further advancement in the indices. So let's take a look at the S&P to start with. So this is it on a daily chart. So you can see the week before last we had a sharp day on the Wednesday, and then we had a slightly sharper day on Thursday of the week just gone. But we did manage to steady on Friday. We've got some some support areas here at around 2412 and again at 2400. I don't know whether this is going to break 2400 or not. If it doesn't, it doesn't really matter. I'd probably be a little bit more concerned if we broke this level here, which is 2328. But if you pan back and look at just during this advance, pulling back to the 200-day moving average, which is the red line, has no particular significance. It's a normal occurrence. So we could pull back all the way down here to 2350, and that would still not negate the uptrend that we've got in place. So there's quite a way to go yet before you could start saying we're getting a correction of something a little deeper. So I think at the moment it's looking like it's likely that we might hold 2400 and then just fluctuate in this 2400 to 2500 range, perhaps for a couple of months, and then we get the stronger part of the run into the end of the year. Let's take a look at the NASDAQ. So this is the NASDAQ on a weekly chart, and you can see that we're still above the steepening trend. So we had an initial trend set up here from the lows in 2016. So that was our initial rate of ascent, and then we got steeper, and we're still not back to that resistance or that support line now. So there's no real sign of weakness in the NASDAQ at this stage. And I do note that on Friday there were actually some technology stocks that did particularly well, that were up 4 or 5% on a pretty negative finish to the week. So that's always a good sign. The Russell, this was the pattern the structure that I put up a few weeks ago. We did break that little short-term trend higher. We also broke down through this support level here. So what looked like a strong breakout has failed, but we've just failed back into the range. So as long as the Russell holds above 1340, then that index is still in good shape, and the market breadth is still pretty good. Let's just look at the VIX index before I move on to the other global indices. So you can see we got a spike up the week before last, and we also got a spike up just in the last couple of days, which mirror the spikes we saw in May and in April. But it can't even get up to the 16 to 20 range, which is this is where you need to be to getting a much more volatile market and signs of a deeper correction. And we haven't had any of those since June of 2016 and then November of 2016. And it's been basically all downhill since then for the volatility index. So there's no real signs there of any nasties coming. The US dollar holding this key support level, bounced a little bit, but hasn't really done much at this stage, and it's certainly not being helped by the political farce in Washington, that's for sure. Turning now to the German DAX. A little bit of weakness over the last few weeks, but we're still holding above the 200-day moving average, so that's still a very good trend, and we're still basically, this is the all-time highs, and we're only a few hundred points off the all-time highs. The FTSE index is really just running along in a steady range at the moment, but again, it's at all-time highs. If we look at the Shanghai index, we've seen this is the Shanghai Composite. So we're way off the ridiculous peaks that we got back here in 2015, and then the Chinese market crashed, and we got down to around 400 on this index. But we're now back almost to 500, and you can see there's a slight upward orientation to that index. So there's certainly nothing nasty about that. It is in a slight uptrend at this stage, and really is just broken out amongst these highs. So you can see we've broken out, come back, retested it, and now we're advancing again. And there's certainly evidence of a huge amount of money starting to rotate into China now. Okay, let's move on to the Australian market. Our dollar fluctuated above and below 79 cents. And our index managed to finish a little higher for the week, 54 points. It's been a pretty mixed earnings season in Australia, and certainly the outlook for the top 20 stocks is pretty somber. So if you're an investor and you're looking to generate returns that are above the market average, then you just have to look outside the top 20. There are some strong short-term and also long-term. So short-term for traders, long-term for investors, small and mid-cap stocks. You've got to look hard to find them, and you've also got to be patient to buy them on good terms. But this is one of the things that I'll be focusing on in this new service, of course, is bringing those sort of opportunities to your attention. So let's just take a look at, first of all, the Australian dollar. So we broke above this resistance level at 78 and a quarter. We got up to just over 80. Pulled back, we've retested it, and then bounced a little bit in the last week. But we may just sort of run around in this range here for a while, between 78 and 80. But it's obviously highly dependent on what the American dollar does. The Australian index still stuck, this range getting ever so slowly tighter and tighter between 5,700 and 5,800, and we're really just becalmed there, and I really can't see what's going to move that index out of that range. This is gold on a weekly chart, so you can see the big long-term picture that we had. We advanced in that really good move in the first half of 2016. We advanced to exactly the 38.2% retracement of that whole run down from 2011. We came back more deeply than what I would have expected, but you can see there is an upward orientation to what's been happening here over the last 6 or 8 months, and you can see that we've managed to poke above that long-term resistance line, so we've been able to break that. But at this point, if we zero in on the daily, we still haven't been able to break this horizontal resistance at 1300. Had a little peep above it during the week, but wasn't able to hold. So we're still looking for that breakout there. This is GDX on a weekly chart, and you can see we're just progressing into a narrower and narrower triangle that's forming there. And I'm going to leave this up as we go forward in the coming months, because this is what we need to see to demonstrate that the sector's moving. We want to see a run up to resistance up here to initially 27.5. We want to see that run up on rising volume. We're not seeing that yet. We want to see the range of the candles expanding, and we're certainly not seeing that. And ultimately, we want to see a breakout above 31, 32 on higher volume. So none of those things are evident. So whilst that remains the case, then I think gold holdings, which I think are still valid. I think having a small proportion of your portfolio in gold stocks is a good hedge, but not really beyond that at this stage. So gold was down by just a couple of dollars. Wasn't able to hold it, so I've covered all that. The GLD holdings in the ETF were stronger to 800 tons, so a little bit of money coming back into the ETFs. And of course, precious metal stocks, there's just nothing showing there yet. Copper advanced to 293. Crude oil was steady at around 48.50, but stocks were still weak, so we're still in this accumulation phase for energy stocks. There's the copper chart, and there's the oil chart. So wrapping it up, how to play mini corrections, because I think that's what we're perhaps going into now, mini correction or a trading range, and probably not too much downside. To me, the best way to play this when we're not quite certain what the next few weeks or few months is going to hold is to buy progressively. If you've got enough funds, buy half or a third, and then wait for a few days or a few weeks and add to that, because timing the exact bottom is it's an impossible task, and you'll end up tripping yourself up if you try to do that. So just build your positions progressively. I expect sector rotations to continue. This is a weaker and lower volume time of the year. It's summer holidays in America. The liquidity is lower. That tends to mean that prices can move around a bit more. So don't expect miracles in this period. However, as members know, some stocks are doing fabulously well, and there are more that are just breaking out, particularly in the last couple of days. I'm really excited about the start of next week, because there's a whole bunch of stocks that showed really robust behavior on Thursday and Friday, and some of the most productive pricing patterns that I've seen in a long time. So I'm really enthused about that. That's it for this week. There's my contact details for anyone who wishes to communicate with me, and look out for the launch details of that new service through the week. Be back with you next Sunday. Cheers.